The following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there had a fun and profitable and safe trading week. There's been a lot of interesting vacillations we've seen in the broad market and in volatility and in the commodities, and there's been a lot of areas for our listeners to get nipped if they weren't careful. So hopefully all of our listeners out there were hedged and were trading appropriately and safely and have had a profitable week.
Or we're short gold, silver, crude, and
exactly.
A few other items.
Yeah, you were long the whole run up, and then you immediately turned to the dark side as soon as you saw those margin requirements changing. And if so, you were more nimble than the vast majority of traders out there. My name is Mark Longo, and I am your host for this jolly frolic through the world of volatility. And I am joined by none other than the man, the myth, the legend himself, Don Schlesinger from the Volatility Exchange. Don, how are you doing today?
Just great. And, volatility is the name of the game. And this week we had it in spades. So lots of interesting things to talk about today, and hope the listeners will stay tuned.
I don't think we'll have too much trouble with that. We've had some interesting episodes so far, including last week. Last week was a fantastic one. We had Professor, if you missed it, I encourage all of our listeners to go back and download Volatility Views episode 6. We had Professor Robert Engle on, the Nobel laureate of economics for 2003, and the author of the Arch and Garch models, which are very prominently used in volatility and volatility trading and modeling these days. It was a very interesting episode. Now, we had a lot of great feedback on that episode. And so if you did miss it, go back in your feed or download it from the Options Insider website or download it from iTunes, and you should give it a listen. It's really a fantastic episode. All right, and with that, we're going to roll right into our Volatility Week in Review.
It's time for the Volatility Review.
And we're going to kick things off with our volatility pit reporter, none other than good old Mark Sebastian from optionpit.com. And Mr. Sebastian, what did you see in your volatility week in review?
This is it's interesting. The one time I was on for the full session, Don and I got in a little tiff because he was talking about, if you're saying vol's going up, you're saying the market's going down. Well, interestingly, for the up until yesterday and kind of the day before, we were kind of rallying. When we rallied from about 1345-ish, 1335-ish up to 1360, implied volatility rallied with it the entire way up. It turned into a huge disaster for anybody that was short call spreads, because you were getting beaten in every way you don't expect a call spread to beat you. You got beat on Delta, and you got beat on vol. And it was really one of those rare events. Well, you know what it led up to? Kind of Thursday, which was a really nice drop in the market, followed by kind of a rally back today. So all in all, vol pretty much up on the week, pretty aggressively. In fact, it's Friday, kind of the midday, and the S&P's up 10 handles, and vol's only in about 0.2, according to the VIX, is only in about 0.2%.
Yeah, we're not seeing the usual end of weekend type crushing.
No, and in fact, a 10-point up move and a VIX up 0.2%. I haven't run the numbers, but I'm guessing that actually vol's probably up a little bit today. So, we've seen since we hit that low of in the 14s on VIX, a real increase in market implied volatility.
Yeah, that much touted low that every media outlet ran with it, lowest since July 2007 for the VIX cash. They don't say VIX cash, they just say the VIX.
Right. Well, and then they completely quote the VIX wrong. I yell at my editor at the street all the time because she'll quote VIX options against the VIX cash, and I tell her, don't do that.
Oh,
Just
really?
stop.
Even at
Makes
that makes you look like an idiot. That's fantastic. There we go.
It doesn't make me look like an idiot. It makes her look like an idiot.
But it's under your name. People don't have that nuance,
No, it's in her market wrap.
Okay, all right. Gotta love editors. Well, thank you for that, Mr. Sebastian. And, of course, we'll also look at the whole purview of volatility products on this show. And there were indeed a lot of interesting developments in Eurovol last week as well. So, Don, why don't you give our listeners a bit of a rundown on the surprising or perhaps not so surprising pop in Eurovol?
Well, it was really interesting. We spoke about Robert Engle, and we mentioned briefly last week, I'm probably the last person in the world that you expect to hear say, maybe you should buy a little volatility, and maybe this is going to be going higher.
You can probably count those times on one hand, I would think.
You got it, but you remember that we were looking at those G-vols on the VolX website screen. Those were the Volatility Institute forecasts for future volatility or for the expiration value of the current euro contract. And I recall mentioning that it seemed to have been somewhat higher than what the current value of the contract was a week ago, and also what the logged or partial realized volatility was. And so I kind of casually recall mentioning maybe this might in fact be a good time to take a look at possibly owning the contract through the expiration. And of course, I really didn't expect what happened yesterday, where we're recording on Friday, and there was this huge $2 pop in the actual euro vol contract price yesterday. So as we head into settlement in just a little while, we see that it's trading around about a 12 and a quarter price, about 11.85 bid, offered at about 12 and a half or so. And so it's going to be interesting to see that this particular settlement will be considerably higher than the previous two, which were the March and April contracts. I actually use one of the new tools on our website. I'll get a quick mention of that in. If listeners go to the data pull-down menu, and they go to vol contract volume, that will actually default to charts that give you volume and open interest of the current contracts, but they also have a chart type selection in the menu that allows you to pull down open, high, low, and settlement prices on a historical basis for any of our contracts that have been listed. So I played around with that a little bit, looking at this May contract that was actually listed a couple of months ago, and I found just by perusing the data some really interesting things. We opened at around the 1310 range, and what had been typical action for a while actually saw the contract drop all the way to 928 before a first rally took it all the way back up to 1184, only to see it drop down again to 945. And then this current rally brought it all the way back up to the 12 range, where we predict that it'll probably settle this afternoon above 12. So if you're looking for action, this volatility of volatility, 1 month volatility, can really be extraordinary, because those moves that I was talking about are sometimes in excess of 40% in one direction or another.
That's quite the roller coaster you have going on out
there.
Well,
the average vol of vol for the 1 month euro is somewhere in the neighborhood of about 83% or so. But as of last night, the current vol of vol going back 21 days was 105. So this contract, as you say, has been a swinger. It's been on a roller coaster. And again, for our fast traders, algorithmic day traders, those looking to speculate, those looking for action, that's the place to be in the 1 month contract.
It's hard to believe that people are still hesitant to dive into the product because they're afraid that one single data point won't generate much movement. I think that's really a good point as well, because obviously when you do have an extremely volatile day, and even though we were very close to the expiration, we were 2 days away yesterday and 1 day today, we reiterate that point that we've made a couple of times already, that even with the averaging process, and even with 18 or 19 data points already logged in the formula, a single day's worth of really impressive volatility can move this calculation value quite a lot. And for the reasons you just mentioned, people should not be leery of something that is actually accumulating data points along the way, because even right up until the very last day, we have the potential for considerable movement. I would think this data set from the past month would be the final nail in that coffin, I would think. Just bring that with you whenever someone raises that question or concern about their product, and to say, here, let's look at the April into May data set, and that'll be the end of that.
There you go.
All right, Don. And that's going to do it for our Volatility Week in Review. And we're going to roll right into our listener mail segment. We didn't have a chance to answer any questions last week because we devoted the full hour to Professor Engle. So we have a lot of questions piling up in the old mailbag.
Listener mail. Listener mail. Listeners write in.
All right, and welcome to the listener mail section. This is where we, as the name implies, answer your mail. And we have some interesting questions coming in to the forums and via email. I understand, Don, you're even fielding a few phone calls.
Yes, I actually did have a phone call from someone who called the Volatility Exchange, and it was forwarded to me. Had a nice chat with him, and he actually pointed out that there were a couple of unanswered questions that I hadn't been able to get to on the forum, so we responded to those, and we're going to both answer more that have come in, and I'll write out and type out some answers as well.
So yeah, listeners, we definitely encourage your feedback, and we try to get back to you in a timely manner whenever possible. Don will even interrupt his evening meal, his dinner, just to take your phone calls. That's how nice he is. All right, we're going to start things off with our first question from in the old mailbag from a user on our forum, the Options Insider Forum. And indeed, if you want to post your questions for the mailbag, then surf on over to theoptionsinsider.com and then click on the forum tab at the top of the page and scroll on down to the Volatility Views section of the forum. It is alphabetical, so the V section will be towards the bottom of the page, just be forewarned. So you're not scrolling for a while and saying, where is the Vol section or the Vol Views section? All right, we're going to start things off with a post from Tic Tac in our forum. He goes by the name Tic Tac. I like that. And his post is titled, Selling in the Money Covered Calls to Capture Skew. He says, I've read a few articles now suggesting that covered call writers move their rights from out-of-the-money calls to in-the-money calls. And the reasoning behind this switch is that these calls would allow you to capture more of the volatility skew. Is that correct? Does this technique allow you to capture more volatility skew? Well, Tic Tac, you are indeed very timely in your question. This has been a popular trend and a popular discussion point in the options market for the better part of the past year or so. We've seen a lot. As our listeners know, the covered call is one of the most popular option strategies out there for both beginner options traders who are coming into the options market and looking to generate some income on a long equity portfolio, to some of the more advanced traders out there who use covered rights as part of other strategies. There's a lot of things you can do with them, and they're very popular, very simple to execute strategy. You can incorporate them into collars and do a variety of other things. But you're right, the traditional way to do a covered call is usually to pick whatever 1%, 2%, 5% out of the money call and write that against your long equity position. The fundamental thinking behind that was you wanted to give yourself a little bit of room to the upside, because presumably you're holding a long equity position because you think there is some upside to that position, and so you don't want to cut yourself off too much, so you write a near-term out-of-the-money call, and that gives you a little bit of income, a little bit of cushion, and it caps the extreme upside of your position, but it also generates a nice bit of monthly income for you. And that's been the way covered calls have been done since time immemorial. But we are seeing options traders starting to switch to, like you said, in-the-money covered calls. And that is precisely for that reason, because as we've discussed in previous shows, the old call wing and the put wing of the volatility skew, the call wing is essentially the area of the strike chart above the at-the-money. The put wing is considered to be the strikes below the at-the-money level. And the premium levels and the levels of volatility in those downside puts in the put wing is typically higher. If you are writing in the money strikes in that put wing, you are able to capture the higher levels of premium, the higher levels of volatility in those downside strikes. And so that is correct. You are capturing more of the volatility skew, as your question asks, if you want to term it that way. Of course, there is indeed a downside to that, no pun intended. That is, you are essentially clipping the bulk of your upside in that underlying position. If you're writing in-the-money calls, you are increasing your chances, obviously, that underlying is going to be called away at the expiration of that option. And so you're collecting more premium in return, allow that underlying to be called away. But if you're expecting a near-term bump to the upside in your underlying position, I don't think I would run out right now and start writing in-the-money covered calls unless you feel that the premium there and the volatility levels are worth it and they offset what you're looking to gain in the near-term upside in your position. So if you're holding on to an equity, let's say a Microsoft, it tends to vacillate around that at-the-money strike and doesn't have much in the way of extended movement. You're not expecting a significant upside pop anytime in the near term, then writing in-the-money covered calls might not be a bad way to go. Of course, when you're getting called away every month, you will have to reestablish the position again every month, so there are some extra commissions involved and there's some extra legwork involved in this strategy. But overall, if you have an underlying that isn't vacillating too much and you want to generate a little bit extra income and you don't mind going through the hassle of having your underlying called away on a regular basis and having to reestablish a position, then in-the-money covered calls are indeed a good way to go. And especially as we've seen recently with volatility levels coming off across the board, it is getting harder and harder to find strikes that are good candidates for covered writes. So like I said, a lot of these savvier traders are starting to migrate their covered liquidity into the in-the-money strikes. Don, do you have anything to add to that?
Well, you've made all of the salient points, and very clearly, I surely would have answered in a similar fashion. I will make one comment, and it's something that I think most of our sophisticated listeners are aware of, but I think it bears making the point, and that is often people talk about the skew and they talk about the high implied volatility of the puts below the market and the somewhat lower implied volatility of the calls above, and they often fail to make the very point that we're discussing here, and that is those same high implied volatilities for the puts below the market are associated with the calls below the market, or the in-the-money calls as well, and vice versa for the puts that are in the money up above. And that's simply because there is this well-known put-call parity formula that basically drives the relationship between the price of the underlying, whether it's a stock or a futures contract, and the puts and the calls at the same strike on the underlying. So that relationship, which is mathematical, has to be preserved. Now, what happens is, it's very interesting. Suppose you have this deep in the money call or an in the money call that our questioner Tic Tac was inquiring about, and maybe you're $10-12 in the money, so that the price of the call might be around that range. There's not lots of time premium when you go deep in the money, and then the put could be very cheap. The put could be $1 or $2 or something like that. And you say, well, the implied volatility is higher. We're below the market, so the implied volatility is cranked up a little bit here. You say, what's the sensitivity of the put to the change in implied volatility, 1 point higher, for example? We call that the vega. Maybe it's 20 cents or something like that. Now you look at the 20 cents and you say, boy, 20 cents on a $2 option or on a $1 option, gee, that's 20% or 10% of the value of the option. That's really significant. And then you turn to the same strike call and you wonder, gee, if volatility moves 1%, what's going to be the effect on the price of the call? And people who are not accustomed to this might think, wow, I'm getting 10%. Maybe that call price will change by $1 or more. And of course, our sophisticated listeners know that that's not at all the case, and that the trick answer is that the price of the call changes by exactly the same amount as the price of the put, the same 20 cents, because of that put-call parity formula, which requires that they stay in line like that. So when you're looking at a $10 or a $12 call option, and now volatility goes up a little bit, you realize that, a 20-cent bump up, well, yeah, it's 20 cents, can't deny that, but as a percentage of the price of the call option, it isn't really all that great. And so you have to weigh that against some of the negatives that you so clearly brought out, constantly being called away, particularly if it's a dividend-paying stock, and perhaps even more importantly, the limited upside potential because you're already in the money. So really is no upside potential. Everything that the stock goes up is taken away by being short the call, and all you do have to make is whatever time premium there is. So they're almost bond-like returns, and you have to weigh that against some of the other negatives.
Yeah, I don't know if I would take this approach in a high flyer like an SLV or something like that, where you're moving, or an Apple, where you're moving 5-10 handles a day. You
almost surely want to give yourself the upside potential, and obviously in any buy right, especially the ones where you are above the market, there's always two components to the return. One is what we call a static return. Even if the stock doesn't move at all, what kind of return can I get simply by virtue of collecting the option premium? And then there's what we call the call away return. That's the maximum return possible if not only you've collected the premium, but the stock has moved up to the strike. And so basically speaking, that component is lacking when you do in the money buy right or covered right, because as you mentioned, you've simply already capped your upside by virtue of the in the money call.
And I think you mentioned a good point too, which is something we bring up time and again, but it is worth repeating on this show as well. As that's one of the key differences we see between retail and professional options traders in terms of how they approach options trading. Retail will typically think of positions in terms of calls and puts. I have calls here, I have puts here. Whereas professionals will think in terms of strikes. So you're talking about call put parity. That is exactly why. You're a professional options trader, you just think of what's your position on this strike, what's your net position on this strike. You don't think I have X calls, I have X puts, unless, of course, it is a div stock or something like that where you have a reason to want to exercise calls. But other than that, you're looking at net positions. And so retail, when they come in, they often tend to forget that call put parity component, and they tend to think, I have X on the calls, I have X on the puts. It's very much a different game in a lot of ways.
Yeah, I had somebody very knowledgeable just the other day say to me in the course of a conversation, well, of course, puts have higher volatility than calls, and I kind of stopped him for a minute, and I said, well, exactly what do you mean by that? He says, well, everybody knows puts have higher implied volatilities than calls. I said, well, you want to be a little bit more specific? Which puts are we talking about? Which calls are we talking about? Because I think I probably know what you mean. You probably mean that the same amount out of the money for a put as for a call, the put will have the higher implied volatility, but just be careful the way you describe that.
Yeah, everything in the put wing becomes a put. Everything in the call wing becomes a call. A lot of people don't differentiate between those two. Maybe that's what he was thinking. I will be charitable to your friend there, and I will assume that's what he was talking about.
Well, I'm always kind of careful in describing it, and I prefer to say the options that are below the current level of spot or the forward, and those that are above. And that way you kind of paint them both with the same brush and realize that you're talking about strikes rather than whether it's a call or a put.
All right, and then moving on in the old mailbag, we have a question from the forum from a user who goes by the name Bullspread, and his question is, what is the time frame for new VolX products? And he writes, I like the concept of trading realized volatility. The implied nature of VIX options have prevented me from fully embracing that product. I'm interested in the methodology behind the Eurovol contracts, but I'm not a currency trader. When will VolX have something that an equity options trader can use, perhaps a realized volatility contract on Apple or SPY? On that same note, could you list a realized vol product on SPY, or does the CBOE's license with the S&P restrict that? Thanks and love the show. I can answer the second part for you, which is no. The license doesn't apply to that, which is why SPY is listed on every exchange. SPY options are listed on every exchange you can think of. So I'll answer that second part for you. But as for the first part, I'll have to turn to Don for that one.
Well, I have to tell you, it's almost as if you've been sitting on our shoulder going from meeting to meeting as we are extremely active in pursuing the ability to bring further products to the marketplace. And nobody wants more than the offices of the Volatility Exchange to bring out more products, and we are working feverishly towards that end. We have been meeting with exchanges. We have been meeting with all of the household word investment banks, the biggest of the big, and we've gotten some very favorable responses from several of them. So again, listeners have heard me say this before, the whole concept of actually coming out and becoming a virtual exchange with the regulatory bodies and the agencies involved, and the paperwork is a sometimes slow and tedious process. It really is our business model, and it's what we hope to aspire to become, as opposed to simply going the further licensing route as we have with our first product on the Euro with the CME. That said, we are pursuing various avenues and various potential methodologies, both in the CFTC space and what could eventually be the SEC space. When you mention a product where we could trade realized volatility on something like a single stock name like Apple, that would be more in line with the name that we have, Vol Shares, that would trade like individual stock prices without a multiplier, little different from the futures concept, but of course would settle to the realized volatility of the single stock name. So there's an awful lot of stuff in the pipeline, and we are working diligently to try to make all of this a reality.
Listeners often wonder why we're so down on the SEC and the regulators in the option space, but this is one of the side effects of having regulators who don't really understand the space very well, is that new product approval and new product launches in general take forever. That's definitely one of the chilling effects that having poor regulators can have. It makes it more difficult for guys like you to go out there and bring something new to the marketplace, because in addition to all the typical sales and product introduction education you have to do to get the market to embrace a product, you also have to sit back on your heels and wait for the regulators to wrap their heads around it, which is usually a lengthy process.
And it's a good point that you make, Mark, and it's one that we've been giving a great deal of consideration to because we're very dedicated to education. We're extremely high on bringing out the materials and all of the methods for educating potential end users. But there is that sensitive timing issue. If we go out and we beat the drums and we teach everybody about all of these products and we get them clamoring for them, and we're happy to hear that there is the interest that there is, but then we aren't able to get them listed and get them up and trading, well, then there's a certain frustration level. So we want to try to make sure that when we start talking about these things and we start doing our seminars and conferences and educational materials and what have you, that we really can bring the product out in due time, in timely fashion, so that there's a connect between the two. I often kiddingly say to people when I go to the movies and I see coming attractions and I say, gee, that looks terrific, I can't wait to see it, I want them to tell me that the movie's coming out next week or next month, not 6 months from now, and then I have to cool my heels. So that's something that we're considering as well.
All right, and then we have an email here from Tom, and this email came into the website, and he says, I just wanted to thank you guys for putting together that volatility cones tool. I've been writing downside puts and put spreads in SPY for some time, and it's nice to be able to use that tool to see where my volatility levels fall on the overall spectrum. It adds an extra bit of confidence to my selling and, as Don would say, not selling of SPY options. Don, your parlance is spreading. You are. Little Don Schlesinger is everywhere running around quoting you. It's a frightening prospect, sir. Then in addition to thanking you, he says, quick question, any plans to add individual equities? I know that's a lot of additional work, but it would be great to be able to crank out a vol cone for front month Apple, etc., etc. So another one, Don, I cannot answer. Any plans to further tweak that vol cones tool?
Well, there very well might be now that we get interest such as this, because the methodology is there. It's just simply accessing the database and making more underlying assets available. So we've kind of started out with all of the major indices and, of course, the currencies and what we're actually trading now on CME. But if we have interest, and as a research tool, we can put out the same methodology on individual stock names, it certainly sounds feasible to me. I'll consult with our webmaster and our CEO, and if everybody's on board, to try to broaden somewhat the underlying assets and the variety that we offer, we'll certainly take the suggestion seriously and perhaps bring that out as an enhancement.
Once you've already done the initial calculations and developing of the tool, adding the additional data sets, as you say, is a little bit easier than rebuilding the tool from scratch or doing something or starting the tool over. Once you have the methodology up and running, adding additional data is an incremental task.
Yep, and listeners will have my promise. As soon as we're off the air, the email will go out. Hey, guys, what do you think about this? And we'll kick around the idea.
Your poor webmaster is going to start hating the show. every time you finish an episode, he's got a new project.
We keep him very busy, and he's doing a spectacular job. His name is Norm Wattenberger. He's really a genius at what he does. And if you haven't taken a look at the website already, have a look at volx.us. We think you'll like what you see.
All right, and then we're going to close up the old mailbag with more of a comment than a question, but I thought it was emblematic of all the feedback we received on last week's show, which was essentially we have a post in the forum that says, great job on the Robert Engle show. That was a fascinating guest and a fantastic episode. Thanks so much for bringing on Engle. It was a truly fascinating hour. I only hope you bring him on again. Good job translating the discussion mark and making sure it was something that guests of all levels could enjoy. I'm very excited to see who you guys bring on next. Well, thank you for that and for everyone who wrote in for that feedback. It was indeed a fun show, and Don and I were very happy to do it. And the only downside now is that we've set a very high bar for ourselves.
Yep, I guess those who follow a Nobel laureate have their work cut out for them. But of course, it was a privilege to have Professor Engle on the show. I have no doubt that he will be happy to come back sometime in the future and do perhaps even multiple episodes. But we have a couple of whom I think will be very fascinating, highly experienced guests in the pipeline. We have contacted a couple of them. Won't mention the names right now. We'll wait to see if it materializes and they're able to come on. But we're going to try very hard to mix shows such as this one, where it's just Mark and me, and others in which we do bring on interesting guests to keep it light and have a variety of conversations. So stay tuned, and we promise that we will have other exciting guests for you.
All right, and that's going to do it for the old mailbag this week, but keep those questions coming in. We love to hear from you. We like to hear from you via the forum, of course, or you can send emails to questions@theoptionsinsider.com, or you can reach us via Twitter at twitter.com/options or twitter.com/VolX_info. I always want to say VolX_US, but it's VolX_info. And of course, the brave among you who are not afraid to hear your voice played on the air can leave us a voicemail at 312-544-9356. The forum posts and the emails seem to be the preferred way of contact right now, but we'd like to see some hardy souls take a shot at the voicemail who aren't afraid and want to be immortalized for all of their friends and neighbors on the old Volatility Views show. All right, and that's going to do it for the mailbag, and we're going to roll right into the Crystal Ball segment.
And now we take a look at the crystal ball.
Welcome to the Crystal Ball. This is the section of the show where Don speculates wildly, and I have to rein him in before he makes some insane prognostications. No, actually, this is where we talk about what we're thinking and what we're expecting in the upcoming sessions in terms of volatility. And we're going to toss it over to our old friend, our volatility pit reporter, Mark Sebastian, to see what he's got cooking up in his crystal ball for the coming week.
We're done with the single digits for a little while. That's my kind of thoughts. Mark, what do you think?
Well, not with every single commodity on the planet just taking a nosedive this past week. It'd be hard to imagine volatility staying at those July 2007 low levels. It would make no sense. I'm looking at the charts here while we're talking. It looks like SLV has finally turned to the positive after the drubbing it's taken over the past few days.
Yep.
And
GLD the same.
Yeah, GLD the same. I don't have oil up here, but I imagine oil is probably taking a little bit of a breather from the sell-off as well. So yeah, with all this vacillation in the broad market, it would make no sense if volatility didn't follow suit.
Absolutely.
And thank you for that, Mark. And of course, we do cover the full spectrum of volatility products. And Don, you made a very prescient prediction last week of a impending spike in Eurovol on the Eurovol contracts. We want to try to go 2 for 2 this week?
Well, I'll be a little bit more conservative on this particular segment, and I'll make a prediction that's going to be 100% accurate, and that is we have a May vol contract expiration this afternoon. So that contract will expire. We begin the June realized volatility period, and concurrent with that is the 3-month June quarterly contract as well. That's gone about 2/3 of the way into its 63-day realized volatility period already. So listeners have 2 different ways to trade upcoming currency volatility, both in the 1-month shorter dated product and the 3-month longer dated product. Take a look at the similarities and the differences between them. So far as the markets are concerned, we are now taping at about 2 p.m. Eastern Time, and about half of the gains of the rather volatile day have started to dissipate. It'll be interesting to see where we close, but obviously this has been a very volatile week, and volatility often begets volatility in what we call persistence or clustering. So chances are that next week might be more of the same.
Yeah, you mentioned it has been a very volatile week, and indeed we have seen an explosion of interest and questions and concerns and feedback regarding the commodity sector. Of course, the silver futures and SLV and GLD and all those other products, oil as well, both the oil big futures and USO. So there's a lot of interest in commodity skew. We saw, of course, an explosion, I think is the only way you could describe it, in upside skew in SLV over the past week. And that, of course, was followed by the utter decimation of that upside skew as SLV collapsed. And so it's interesting to see how the commodity skew plays out. And a lot of people are trying to understand that and wrap their heads around it, especially because the bulk of them are used to the old equity skew, which we just discussed earlier in the show, where the put wing has an elevated level of premium relative to the call wing, and that's the way most people are used to trading. And in the commodity world, it's a different game. You have more concerns about explosions to the upside than you do crashes to the downside in many cases. So figuring out how that skew works and incorporating that into their trading strategy has been a big component of our feedback and our content over the past week. That's probably something we should address in some future shows down the road. Maybe do a quick overview of equity skew versus commodity skew, and then kind of take it from there, I think, and we can expand upon that again in future episodes.
Yes, I think we should, because we sometimes tend to focus more on the equity side of things. We're talking about volatility products, and so far on listed exchanges, people are very familiar with VIX and therefore with the equity exposure. We now have the euro currency, but we should address commodities as well. Take a look at what some of those skews look like. What are the shapes compared to the equity skew? And for that matter, how is the currency skew and FX very different from equities as well? So that would be something that we ought to get into down the road.
Yes, of course. You also have the currency products, and FX skew is another beast entirely from commodity and from equity skew. So we could dive into those dark waters as well.
Absolutely.
All right, Don, that's going to do it for this episode of Volatility Views. I want to thank all of our listeners for downloading and streaming and subscribing to this show, and even though it's new, making it such a success. And I want to also thank my partner in crime here, good old Mr. Don Schlesinger. And obviously we talked about the Volatility Cones tool already. Is there anything else you want to apprise our listeners of that's going on the old volx.us website?
Well, things are happening so fast, I often wonder if I'm aware of everything that's there. But in mentioning that vol contract volume and open interest charting capability that we also added in the past week, I think we are more or less caught up on the new features. But don't be surprised if by next week we'll have something else to talk about. So take a look at the website, and hopefully you'll find all of the tools helpful in your trading and in your research.
Well, of course, our listeners can also, if they want to learn more about volatility or post a question for the hosts of this show, Don and myself, or just read more about unusual options activity or check out any of the other shows on the old Options Insider Radio Network, then they should surf over to theoptionsinsider.com. I think you'll like what you find there. And, of course, that's going to do it for this episode. And I want to thank all of our listeners for downloading and streaming and subscribing to this show. And have a safe, that's probably the operative word these days, have a profitable but also a safe trading week. And we'll see you here next time, right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.